There is a window closing on 30 June, and missing it could cost you thousands in tax. The ATO 12-month rule lets you prepay certain deductible expenses before year-end and claim the full amount in your 2025-26 return, including up to $36,000 of investment loan interest. The ATO has reconfirmed its prepayment rules for the 2026 income year. Under the guidance titled Deductions for Prepaid Expenses 2026, salary earners and investors can fully deduct a prepaid expense in the year they pay it, as long as the eligible service period is 12 months or less and ends by 30 June 2027. This matters because of timing. Normally you deduct an expense as it falls due, paying monthly and claiming bit by bit, but the 12-month rule lets you bring an entire year of deductions forward into 2025-26, according to the ATO. That reduces this year's taxable income and this year's tax bill instead of next year's. This affects property investors and employees alike. Take an investor with a $600,000 loan at 6% who prepays a full year of interest. That brings forward a $36,000 deduction. And at a 37% marginal rate, it works out to a $13,320 tax saving in 2025-26. That figure is our own worked example using the ATO's prepayment rules, not an official ATO estimate. That single number is the headline here. On our worked example, prepaying $36,000 of interest before 30 June saves about $13,320 in tax at the 37% marginal rate, compared with claiming it slowly next year. It is a straightforward calculation from the deduction and your tax rate, not an official ATO figure. Here is the catch buried in the rules. The eligible service period must be 12 months or less and no later than 30 June 2027. Or you have to apportion the cost across years, and not every cost qualifies. Prepaying loan interest needs your lender's agreement and is treated as interest, not a generic service, so confirm eligibility before you pay. The ATO also notes that if your income is higher this year than next, bringing deductions forward saves them at the higher marginal rate. Here is what to do before 30th of June. First, log into MyGov and review last year's deductions to list recurring costs like investment loan interest, professional memberships, software and insurance. Second, contact your lenders, insurers and providers to arrange prepayment of up to 12 months. Third, keep every invoice because the ATO requires written evidence once your total deductions exceed $300. Mark the date. Payments made on or before 30th of June 2026 count toward this year's return, but anything paid on or after 1st July falls into the 2026-27 year, according to the ATO. Once 30 June passes, this opportunity is gone for another year. Looking ahead, the real value comes from repeating this whenever you move from a higher to a lower tax bracket. Our own worked modelling shows a single transition year can yield an extra $2,905, and across 3 such years that rises to about $8,715 in extra tax saved, purely from timing. Treat those as illustrative estimates, not guaranteed outcomes. This is the kind of deadline that quietly slips past most people every year. Subscribe to the fine print and we'll keep you across every cutoff, rule change and chance to save, explained in plain English before it's too late.